Hello, everyone. My name is Dave Casper, and I'm the U.S. CEO for BMO. Thanks to everyone for joining us on what I think will be a very important conversation. We've got a great balance of expertise on this call today. Two very well-respected medical professionals here in Chicago. Dr. Paul Casey, who is the Chief Medical Officer at Rush University Medical Center, and Angelique Richard, the Senior Vice President of Hospital Operations and the Chief Nursing Officer at Rush. Thanks to both of them for their time. Many of you may not know this, but BMO and Rush have had a great partnership over many, many years. And it's taken different shapes, including the recent launch of what we're very proud of, the Rush BMO Institute for Health Equity. It's a great chance to see our partnership continue to grow and help improve the equity here in Chicago. We also have some superstars from BMO Capital Markets with us as well. Brian Belsky, our Chief Investment Strategist, and Margaret Cairns, the Head of Fixed Income Macro Strategy. Brian will speak on how to look at the economy and the markets today, how they've trended throughout the pandemic, and factors that may impact where the economy and the markets will go from here. And Margaret will provide an update on the Federal Reserve and the Treasury. Lots to talk about there. To our customers on the call today, thank you for your business. Thanks for putting your trust in BMO and taking the time out of your schedules today to join us for what I'm hoping will be a lively and informative discussion. We'll have questions at the end, and you can submit those questions during the call by typing them into the chat at the bottom of your screen. Before we begin, I want to put the disclaimer on that the contents that you're going to hear today are for information purposes. Please see and consult your physician if you have any health questions, but we have some great sources here today. So let's start with our good friends from Rush. First off to Dr. Casey, first question. Hello, Paul. Thank you for joining. Hello, Angelique.
Good morning. Thanks for having us.
Well, thank you. So, Paul, first question to you. Give us kind of an update. Where do we currently stand on the pandemic, especially now that we have variants and as kids return to school and people go back to work?
Yeah, absolutely. Thanks, David. And thank you again to everyone that was able to join, as well as for the continued partnership with BMO Harris. It's something we're really proud of and talk a lot about at Rush as well, the joint work around health equity. So I'll tell you, certainly no surprise to anyone that we are still well in the midst of the pandemic, although we are beginning to see the downward slope of the Delta variant that has really caused the surge of cases since about mid-July, where it became the predominant strain throughout the United States, and prior to that had, of course, gone through Europe as well as India. So that's encouraging that we are seeing cases go down in most places throughout the country. Now, I think the other thing that's important to note is that when one looks at the map of hotspots throughout the country or places where there are still cases, it's really inversely proportionate to the vaccination rate in those areas. And that's no surprise, with what we know about the vaccine efficacy, that we continue to see a number of hotspots pop up where there just hasn't been that level of uptake as we'd like with the vaccination. So again, one thing we've learned about this pandemic is it's inherently unpredictable. That being said, we closely trend the cases throughout the country and certainly here in Chicago, and we're encouraged by what we've seen in the last week or two.
Paul, question, and because we're a North American bank, I was just down the hall with my Canadian colleagues that are here in the U.S. today, and they are just about at 80% of double vax of those that are eligible. Where do we stand? Where do we stand in some of the real hot spots on that? And then also give us a little update on the booster as well.
Yeah, absolutely. So, the vaccine uptake here in the United States has really been quite variable. There are areas, overall, when you look at the United States on a whole, it's about 55% of Americans of eligible Americans that have been vaccinated, fully vaccinated, and about 64% of Americans that have had at least one vaccine. Now, That also varies quite a bit by age group. The good news there is that it's about 83% of those over 65 that are fully vaccinated and 94 that have received at least one vaccination. And that's certainly the most at-risk group for it as well. So we still see the trend as well in terms of the vaccination rate. I can tell you that here in Chicago, where we closely track the hospitalizations, that about 99% of the patients that we see that are hospitalized are unvaccinated. So, and that's really the case throughout the United States, and I'm sure other countries throughout the world, is that the hospitalizations are really being driven by the unvaccinated. So where we see in the news, states and cities that are overwhelmed and have no more ICU capacity, those are the states and cities in which the vaccination rate tends to be quite low. Now, in terms of the vaccine boosters, obviously that a lot of that news is just emerging. And like any vaccine, we've seen the science is really telling us what we expected with the COVID vaccine, that over time the immunity would wane somewhat in terms of the efficacy, and that's the case for the vast majority of vaccines. We're seeing that the data is really supporting that that's most pronounced in those that are over 60 or 65 years old. And that was a study out of Israel that really helped the CDC to guide that decision, because they've been following this closely. And it looks like that waning immunity starts around 6 months after the second dose of the vaccine. So thus the recommendations of the CDC advisory panel to do a booster vaccine after 6 months for those that are over 65 or those that are high risk, as the CDC director Rochelle Walensky put forward, people in high risk exposure, they are also recommended to get that booster vaccine. So something we've certainly gotten a lot of questions about here at Rush, and we've made plans to roll that out throughout the city as well.
Angelique, as we all know, there are a lot of people still who, for their own personal reasons, are deciding not to get the vaccination. Can you give us your insights, kind of explain the hesitancy and some of the ramifications of this?
Sure, Dave. I too want to thank BMO for having this. I think doing this is one of the most important things that we can do for our employees and quite frankly at large. There are multiple reasons for hesitancy. There's fear, there's lack of information or a knowledge deficit. There's myths and untruths about the virus as well as the vaccine. And there's mistrust among some around the vaccine, as well as, in some cases, healthcare as a whole. And I think the ramifications and the consequences of this are what we're seeing, right? I think it's this increase in cases, the growing numbers in different parts of the country of COVID cases, opportunities for there to be further virus variants. And as Dr. Casey mentioned, states where you're seeing the highest number of cases, strong correlations with the lowest number of vaccine rates. And obviously the worst consequence is growing deaths from the virus.
So, Angelique, what's this doing? What is this hesitancy doing to the healthcare system and healthcare professionals? And as long as we all, or many of us, woke up today to see what's going on in New York City, where we're firing healthcare professionals if they haven't been vaccinated. So you can take this question anywhere, but I'd love to hear what the impact has been, not only at Rush, but in general.
David's going many places. I think this has truly been one of the most difficult challenges in healthcare, certainly in my lifetime. And in many cases, at many organizations, it's at a crisis level. So there are multiple strains and stressors on the healthcare system. There are shortages, as you just described, of healthcare staff that are either a result of the of taking a position and mandating vaccines, or because of the pandemic itself. There are limited bed capacities and workforce deficits. You hear a lot about nurses on the news, but there's food and nutrition workers and transporters and our EVS and security staff, respiratory therapists. Those are some of the key challenges that healthcare systems are having from a workforce perspective. There's supply and equipment challenges and deficits. There's been a strain on the financial viability of many healthcare organizations and their performance. The limitation of services at different points in this pandemic, such as surgical elective cases, has also been a challenge. And then there's just the access and limitation, again, that many healthcare organizations have either gone through or are going through for patients with non-COVID healthcare needs, somewhat in competition with patients who have COVID. So they're vying for the same resources and the same beds. So it has been a real challenge and a real strain, I think, on healthcare organizations, certainly across the country.
Thanks. And we see it everywhere. So, Paul, back to you. So a large number of our population have actually had COVID now, and some have had it for a year or more. What are we seeing? What's the science tell us about some of the long-term effects of those that have had COVID, regardless of whether it was a mild case or more severe? I'd love to hear that, and I know our audience would as well.
Yeah, that's a great question. Thanks, Dave. And, the honest answer is the science is really still emerging on this. And we're actually participating in a large CDC-sponsored trial around long hauler syndrome, as it's called, and what those symptoms are. We have a multidisciplinary clinic actually here, and I can tell you that the symptoms that we're hearing from those that are at that clinic really tend to be persistence of a cough, really persistent fatigue to the point, we've had a few young, very healthy 30-year-old individuals that say they can barely walk from their car into work. And they also complain of this persistent kind of brain fog or, difficulty with the same cognitive ability. Headaches are common, as well as really myalgias, muscle aches, things like that. So it's clear to us that, this does not or very rarely happens with other common viruses, certainly cold viruses, flu viruses, there's few sequelae, but we are definitely seeing a higher incidence of some of these persistent effects with COVID. So that's something we're keeping an eye on. It's something I think the science will continue to emerge on, but it's not a small number of the population that ends up with some sequelae. Lasting anywhere from weeks to months.
The science yet that says if you've been vaccinated and you have COVID, whether that will make any difference in the long-term effects?
That's really a key question, and I don't think we have the data necessarily now to actually answer that. I think the feeling from what we're seeing early on, and I think the data will support, is that the vaccine's very effective in decreasing the burden of the virus, both the actual amount of virus that one's infected with, as well as those long-term effects. So what we are seeing within our long hauler clinic is really those that are unvaccinated have accounted for 99.9% of the cases we're seeing there. So I think that science will support that as that data emerges.
Thanks. Angelique, all of us that are running businesses or managing businesses are, I think, always questioning our decisions, what we can do, what we can't do. I will say at BMO, we've said, we've no longer made it optional to tell us whether you're vaccinated or not. Everybody has to tell us. That's mandatory. And they either are vaccinated or expect to be, or they're not, or they'll tell us it's really none of your business. And we've said for those that are in category 2 or 3, if your job requires you to come to work, we need to have you tested at least twice a week. And that's kind of going into implementation today. So that's not all the way to a mandate, but it's pretty close. I'd love your ideas. What should we be doing? What can we be doing? What would you suggest to all of us in businesses? What's kind of the best route to take to nip this in the bud as much as possible?
Yeah, I think let me first start by saying I think courageous leadership is needed now more than ever, and so I certainly applaud you and your team, Dave, for making those really really tough decisions. And we've had to make similar ones, so can appreciate the discernment that goes into that. I think that here's the good news. I think there's a lot that can happen and that we can do as it relates to our staff, our employees. I think, this sounds very basic, but it really is. I think we need to seek first to understand where people are at. I think we need to listen and educate individuals, because there's so many, as I said earlier, so many myths and untruths and that they're hearing in their communities as well as on the news. I think in many ways a grassroots approach is the best approach, in particular with those who are struggling with this decision, and they're in a tough position as well, trying to make this decision, and in many cases, determine if they're going to be able to work. So I think that this requires partnerships and mobilization of key trusted individuals. And whether those are, we have partnered with community and religious leaders within the community. This also means, key and trusted individuals within your organization, maybe individuals that look like or have similarities to individuals who are struggling with this decision, would be helpful to them. Sports heroes, we did a huge campaign with them because we recognize the importance that they have in various communities, town halls like this, small groups, kind of a peer-to-peer approach, and personal stories. And if I may, I'll share one of those personal stories. My doorman for over 20 years had really struggled with the decision around getting the vaccine. And I think I had been talking to him since December up until we successfully got he and his teenage son vaccinated. It took every day having a conversation about this. It took understanding and listening to what his fears were. And really what pushed him over the edge was understanding that he trusted me, right? I'm a healthcare provider, I'm a nurse, and offering to give he and his son the vaccine myself, which is ultimately what pushed him, what worked for him. And it was probably, I probably was more excited and happy about that than I was my own vaccine. So that's kind of what I mean about this, make it personal. These are our employees, our greatest assets, and really getting to that kind of grassroots level with them to help them through this discernment and decision. So those are just some ideas, Dave.
Oh, it's a great story, and I'll tell you, I think we've all learned to kind of check our judgment gene in our drawer before we come into work, and listening. Everybody has a story, and it's easy to say, well, how can you be so stupid? And that is actually the wrong approach. I totally agree. You may get a few people asking for house calls, Angelique, because we probably all know a few people that could use your magic touch.
Happy to do it.
So last question for you, Paul. I'm an optimist, and our next speaker, Brian, is the ultimate optimist in a good way. Um, tell us, give us some hope as to why we should be optimistic on where we are in the virus and the pandemic. And if that's the wrong question, you can take me down the other way and tell me why I should not be so optimistic. So I didn't mean to lead the witness.
No, absolutely. I think Angelique and I both fortunately fall in the optimism camp as well around here. So I would say, we are also cautiously optimistic. I mean, when you look back 18 months ago to where this started, where we didn't know what the symptoms were, we didn't know how it spread, we didn't have any effective treatments, we certainly didn't have a preventative treatment like a vaccine. We've come an incredibly long way, and that's reason for optimism. We know so much more about the virus in every single way we possibly can. And we really now know how to prevent the spread of the virus effectively. It's just kind of getting people over that hump to get there, right? I would say I add the cautiously piece because, every new COVID infection allows the virus the opportunity to mutate and create a new variant. And that's why we closely track the variants of concern across the world, because really it's going to take, this isn't a US effort or a Canadian effort, it's a global effort to really get the vaccine levels to where they need to be in order to prevent the emergence of variants. And of course, the concern there is that there may be a variant that could evade the antibodies generated by the vaccine. So that's something we really need to continue to keep a close eye on.
Hey, I'm feeling better. So, Doctors Casey, Dr. Richard, or Paul and Angelique, you guys have been great. I can't thank you enough for all the great work you do at Rush and for all of our communities. So thank you. Keep it up. Really appreciate it. We're now going to turn things over to our BMO Capital Markets side. And our first speaker is my very good friend, our Chief Investment Strategist, Brian Belsky. Brian's going to talk to us a little bit about what he sees in the markets and how all of what we've heard and all of what we know will have an impact on the economy going forward. So over to you, Brian, and thanks again, Paul and Angelique.
Thank you, Dave. I'm excessively humbled to be sharing this with you. This is my 18th or 19th COVID call that we've done for clients, and I'm struck by Paul and Angelique and how clear, concise, and complete they have been with their comments. And Angelique, made an awesome comment with respect to myths and untruths. And many of you know me that I'm a myth and untruth buster, and I seek the truth, and I have faith. And I have faith in the U.S. economy and stock market, and I have faith in the Canadian economy and stock market. And that's what has kept us so bullish. And so at the end of my formal comments, we'll kind of talk about what our forecasts are with respect to what all of this fun stuff means in terms of the Fed and the economy, in terms of the stock market. But I really think people have to kind of step back and pat themselves on the back and really understand that the transition and the pivot that we've made as a society and as a marketplace has been unbelievable. And it really speaks to the strength of the United States stock market, our companies, and the Canadian stock market and our companies. And we have to start believing that. So I'm going to steal Angelique's myth and untruth, and we'll talk about that in a bit. So let's talk about the Fed. My great colleague and friend, Margaret Karen's going to talk more about specifically with respect to interest rates after myself, obviously much more eloquently. But let's talk about the Fed. Let's talk about what that means for the economy and some political things that have been going on, obviously, in Canada and now the U.S., especially this week, and then what it really means for your money. So first off, on the Fed, the top of the house view is that the Fed is most likely not going to be raising rates for a while yet. And the taper talk, which now is kitchen table type fodder, much like quantitative easing was. In fact, back in 2007, 2008, we didn't even know what quantitative easing was. We had to go look it up in the dictionary, just like we had to go look up what taper was. And just for some perspective, we've only had one official taper in the history of the Fed. And it just seems like the market and the economy is way too fixated on the taper. Be that as it may, I think the key thing from the Fed's perspective, in a very big picture standpoint, is they've been excessively communicative. And we're living in an age in society and business that we want to know everything right away. And I believe Mr. Paul has done a very, very good job in terms of kind of laying the groundwork for eventually raising rates. Now, he's been a little bit more ambiguous with respect to his date of raising rates, but pretty clear he's going to talk about tapering in November and then really start doing the tapering in December. That's the House view. And I think it's pretty much consensus as well. So the market likes this, that we seem to have the same type of messaging from the Fed and consistent messaging from the Fed with respect to interest rates. In terms of inflation, the Fed has been very clear that they continue to believe that it's transitory. It seems to me that everybody kind of forgets that the smartest person in the room is the Fed, followed by the stock market, and sometimes they flip back and forth. And we seem to be debating this transitory inflation issue. We're going to go with the Fed. The House view is to go with the Fed and what they're saying with this. And there's been a lot of talk with respect to bottlenecks and the like. And we continue to believe that this is still a quarter or two effect with respect to inflation. And I think the key metric that many people are forgetting with respect to Mr. Powell is that last August at Jackson Hole, he changed the mandate away from inflation and toward employment. And if you read his statement last week, the first thing he talked about was employment. And I think that remains the quandary on how we're going to get to a sub 4% unemployment, which Treasury Secretary Yellen continues to point toward with respect to the Biden administration. So I don't think there's any easy answer exactly when the Fed is going to raise rates. It looks like it's probably going to be well into 2022. But what does that mean for growth? Well, if you take a look at where GDP is in the United States, we're forecasting at BMO 5.8% and 5% in Canada. But what I think is interesting is that we have a pretty big drop-off expected in the U.S. going down to 3.5% GDP. But Canada actually is going to be surpassing the United States next year by about 100 basis points with respect to GDP. And I don't think anyone's talking about that. And I think that really sets up Canada to do quite well, especially here in the fourth quarter, which is our call to outperform from not only an economic perspective, but from a stock market perspective. But I really think that Canada, its fortunes are obviously tied to the United States with respect to cross-border relationship in terms of fundamentals in the economy. But I think many investors around the world need to start thinking more about Canada. On to politics, which you've heard me speak before. We continue to believe that investors give politicians way too much credit. Politics, we've proven that has nothing really to do with the absolute performance of the stock market. It's really about the trajectory of what happens. And I think, too, let's use Angelique's. I have no original thought, so let's talk about Angelique's in terms of myths and untruths. I'll harken back to the fourth quarter following the U.S. election, and then the first quarter following when the blue wave happened, and it happened for real. And there were a lot of fears that a full-blown Democratic government was going to derail the bull market. That didn't happen. We're up 20% this year, and GDP continues to grow. And I think there's too much assumption with respect to giving those politicians too much credit on to what's going to happen this week with respect to the budget battle back and forth. We continue to believe it's the House view that they'll put some sort of patchwork deal together to keep the government open. I think that's pretty clear, and it's easier for President Biden to do that relative to some other presidents, especially given full control of Congress. I think the infrastructure bill is still a little bit iffy, and so too is even more so iffy are the taxes situation. So you kind of go back to the beginning of the year and think about all the myths and untruths with respect to what supposedly was going to happen on the political front. Again, let's not give politicians as much credit as I think maybe the media and we're afraid of. Let's really focus on how strong we are as an economy and how strong we are as a stock market. And we've gotten through this, and we've proven that it's not right to be fearful of what potential politicians could do. Speaking of politics, we had a very important election in Canada this week, and it was status quo. The Liberals won. I think what's interesting is my good friend and colleague Doug Porter wrote about it last weekend in terms of budgets. The biggest province, Ontario, there was analysts seeing a budget deficit of twice what it came out with. And so I think that there's a resounding fear that we're spending too much money. And I think that Canada, from a Bank of Canada perspective, is going to continue to follow Fed with respect to what's happening in interest rates in the United States. But the Canadian economy is doing quite well, and jobs are coming back. And I think the key thing from the Canadian side of things, as it is in the United States, is just the housing side. Housing continues to be very strong, and lending there is very strong, especially on the residential side. So let's talk about what to do with your money. We continue to be bullish, as Dave said. We've been on record by saying the United States stock market has been in a 20 to 25-year bull market that started in 2009. And I think much of this has been driven by excess speculation on the negative side. This year, we were supposed to have a negative year. The month of September was supposed to be bad. You had a lot of people that do what I do from the strategist and economist side, calling for a 10 to 20% price correction, meaning prices will go down. Well, funny thing happened. Prices are basically flat for the month of September. September typically is a more volatile month. However, it's this type of chicken little analysis that I think is more about grabbing headlines and driving fear than what is true. So what is true? Canadian stock market is doing a wonderful job in terms of earnings. In fact, the last couple of months, we've been writing about the earnings recovery in Canada and using adjectives like epic. And that epic earnings growth is transitioning into fantastic cash flow, which of course in Canada, which is very important, dividend growth. And so we think Canada is going to continue to outpace the US, I think, for the fourth quarter and well into 2022 with the great financial companies, the great material companies, great consumer discretionary companies, industrials and material, and those areas that will continue, I think, to outperform. We are overweight the same sectors in the United States, those being financials, consumer discretionary, industrials, and materials. We believe a balanced approach to investing, being equal weight, growth and value is the best way to play it. We've had this ebbs and flows type market. Growth stocks outperform, then value it becomes oversold. And then rallies back up again. Same thing with small, mid, and large. And that's why in the beginning of the year we said equal weight everything. It's been the exact right call. Now, if you care to hear about a 3 to 5 year outlook, we'll provide one. We continue to believe that the stock market is going to be achieving 13 to 15% compound annual growth over the next 5 years, if not 10 years. And our favored sectors by far are technology, communication services, and discretionary. Discretionary because we're good at a couple things in America, especially buying stuff. And what are we buying? We've proven more than ever, especially during the pandemic, with respect to the need and demand for more technology, more content. And I think those trends are going to continue, not just from a personal side, but clearly from a manufacturing side, as we depend more on robotics and more on bringing manufacturing capacity back to the United States. So that leaves us at 4,800 for an S&P 500 target on $210 of earnings. It's the second time we revised our targets for both the U.S. and Canada in a year. We rarely do that. And I think that really speaks to our confidence with respect to what we're saying in stocks in Canada. We think all-time highs for the TSX at $22,000 and $1,400 of earnings. And again, as America goes, so goes Canada. And we love the cross-border relationship on a fundamental basis with respect to that. Now I'm going to hand the ball off to my very good friend, Margaret Cairns, who is BMO Capital Markets Head of Fixed Income, Currency, and Commodity Strategy. Margaret?
Thank you. Thank you very much, Brian. And thank you, everyone, for joining us today. Brian mentioned Fed taper and Treasury market pricing, so I will begin with that. Basically, what's been happening throughout the course of this year is the Treasury market has been pricing to the expectations of how the Fed will react to inflation on the ground and future expectations for inflation. So what we saw earlier this year was the market pricing in a reflation trade, as the expectation was that the Fed would wait to taper and that liftoff would be a few years out. And at that point, tens, of course, reached the highs for the year around 174. And since then, what we've had is the Fed actually messaging that they were not willing to let inflation run hot for too long in order to reach their employment mandate, which of course now includes inclusive employment as well as full employment. So basically earlier in the year, the market thought that inflation was going to run hot for quite a bit of time longer than they're currently pricing. And so what we saw was rates peaked in March, late March, and rallied back down quite hard throughout the remaining course of the year, up until the past few weeks, where once again the market is pushing rates higher. So our view right now is that basically 10 probably have another 10 to 15 basis points to run before we see better buying coming in from our large institutional clients. And we do talk to large institutional clients every single day. And so this is kind of what they're telling us. And we actually think that rates are going to rally back down, back to the 125 to 135 range in 10s by the end of the year. And then next year, we will see a push higher, but not too much higher. We're really looking for 175 to 2% in 10-year yields. To us, what's really going to be critical next year, and even now, I guess a different story in the market, is what will happen to 5-year yields. Now, 5-year yields, of course, should reflect the full Fed tightening cycle. We pushed up just past 1% today, and we expect that pressure to continue through year end, probably reaching 110 to 115, and then 140 by mid-year next year. So again, we're expecting 10s around 175 to 2 and 5s to push up to 140 early next year. In terms of Fed taper, that ship is sailing, as Brian mentioned. The Fed is on a pace to taper, announcing as soon as November, decreasing purchases by $15 billion in total per month. Over this period, the Fed will still purchase $280 billion in treasuries. And the way that we're thinking about tapering is it's a reduction in the tailwind pushing the economy forward. And that is very different than a tightening cycle, which is actually a headwind. And so the market is viewing the headwind. Of course, we know what the headwind does. It slows growth. It will contain inflation. We know the Fed has the tools to fight inflation, and the market does, in fact, believe this. And this is reflected in the still low long-term yields that we see today. So, of course, when the Fed does tighten, which the market is currently pricing for late next year, of course, we are going to have some changes in the composition of the Federal Reserve Board, which could possibly slant more dovish and push the Fed off until 2023. And, of course, a year is a long time in the markets for forecasts. So the data has to evolve as the Fed expects in order for them to lift off later this year. The market's expecting 25 basis point increments, probably about 3 a year. Of course, much more, aggressive than we've seen in this last cycle, where we started off with 1, for an entire year, followed by, 125 a year later. So it really depends on the evolution of the data. We are in the inflation is transitory camp, and we do think that rates will remain relatively low historically. And this is based on the longer-term demographic trends, the technological changes in the economy that should continue to weigh on employment. We also have a part rate problem in the United States that's going to take some time to work out, in addition to the over 5.3 million people, or employment numbers that are 5.3 million below what they were in February of 2020. So this is going to take some time. We do think the curve, of course, is going to continue to flatten by 530s. Interestingly, one thing to note is that we are expecting the U.S. Department of Treasury to begin cutting coupon issuance as soon as November. Our projections are that they would be about $900 billion overfunded next year if they did not cut coupons. So the cuts, actually, $900 billion will be made up via bills as well as coupon cuts. And if you think about that, while the Fed is slowing its purchases and the Treasury is cutting coupons, there's some bit of an offset to that. Now, that said, the amount of Treasury coupon debt that will be available to the public markets next year will be a record amount, over $2 trillion, about $300 billion more than last year. And of course, when the Fed came out of the gates in March of 2020, the net amount available to the public was actually about negative 400 to 500 billion. So our expectation is that the coupon cuts will offset some of the decrease in Treasury purchases. Another positive, I think, for the market that we should probably mention is that the Fed will own and continue to own over $5 trillion in Treasuries. They will roll these over at auction, and that is an enormous amount, right? They own 29% of Treasury coupons outstanding. And so that's still, even though we're decreasing this tailwind to the marketplace, or they are decreasing the tailwind, the fact that they're still holding a large balance of Treasuries is quite positive. In addition to that, they still will be buying 280 billion. Now, of course, when the Fed does start to tighten, it does in fact become a headwind. One question that we are getting over and over again in these markets is about credit spreads. And credit spreads have traded in about a 10 basis point range year to date. They are near the post-Great Financial Crisis types right now. And many are asking, well, if the Fed pushed everybody out the risk curve during QE, will that actually reverse once they slow QE down or actually start tightening? And when we think about this, we think about last year alone, we had 1.7 trillion in treasuries available to the market, and corporate debt issuance was still near record highs. Now, on a net basis, corporate debt issuance should come in around 450 billion this year, well below the over 1 trillion last year. And next year, it'll likely slow as interest rates rise a bit, and so some of that will offset. We continue to expect IG credit spreads to remain near the post-Great Financial type, if not trade slightly through them, before coming under some slight pressure next year, but we're not expecting any great big blowouts in credit spreads. So again, moderately higher interest rates in terms of treasuries next year, really watching the 5-year sector for a 5.30 flattener, and expect 10s in the 1.75 to 2% range, which is probably quite a bit below the rest of the street, but our interest rate call has been quite right over the past several years. So with that, I will pass it back to Dave Casper. Thank you.
Hey, thank you, Margaret. Thank you, Brian. Great summary of what's going on. Okay, we have time for some questions that some have submitted ahead of time when you registered, and some have shown up already. So first question is to Paul. If I previously had COVID 6 months ago, is a vaccine necessary? How long must one wait after having COVID to obtain the vaccine?
That's a great question. And so the recommendation around that is to wait until 90 days after having had COVID for a vaccine. So importantly, if you've had COVID, that's not the equivalent of being vaccinated. So even those that have been sick with COVID still need to get vaccinated. But waiting that 3-month period will make sure you don't have the, you'll be covered through that period and not necessarily have the same reaction to the COVID vaccine itself.
Thanks. Next one, Paul, you're popular. And this could have been mine, but it's not. If I had the Moderna vaccination, should I wait for the Moderna booster to come out?
That's another great question. Yeah, my advice is yes, that the safest bet is to wait to be boosted with the same vaccine as your initial dose. And that, again, is in line with the CDC recommendation. The Moderna booster doses should be approved, we anticipate, in the weeks ahead. So it shouldn't be too long a wait. But the recommendation, if your initial series was with Pfizer, go with Pfizer. If your initial series was with Moderna, go with Moderna. And that's really because that's the data that we have available to us to know how effective those are.
Okay, thank you. Paul, allergies are bad right now. This could be mine too. How would one differentiate between I have my usual allergies or whether or not I need to get COVID tested?
Yeah, this is a tough one. And I can tell you with 3 little boys at home, when one of them wakes up snotty, it changes from what we used to do a couple of years ago about a common cold. So, the advice around this is really, if you get seasonal allergies and you've always had seasonal allergies this time of year and it feels just like those seasonal allergies, in all likelihood, it's your seasonal allergies. If there's any symptoms that are inconsistent with that, the safe bet is to get tested just to be on the very safe side. It has gotten easier, fortunately, with the wide availability of testing in most of our communities to get that test, and you can fairly rapidly get a antigen test that's then followed up with a PCR as a confirmatory study. That's really the more sensitive one. So that would be my advice.
Hey, one for Brian or Margaret. What would a government shutdown, what kind of impact would that have on the markets and the economy? And I guess, why don't you assign the likelihood of that as well?
Ladies first, Margaret.
Oh, thank you. Oh, we've seen this playbook so many times before. I think the base case is that breaching the debt ceiling or letting it go, not resolving it, is not good for either political party with midterm elections next year. Right now, of course, the Republicans and some of the more moderate Democrats want a lower fiscal package, and they're holding the debt ceiling captive to that. We think it'll go down to the 11th hour, but it will be resolved. Full government shutdown, we've been through it. It's disruptive. But at the end of the day, we have seen the playbook before, but the real implications for what's going on in the bill market, where we do have investors that can't risk buying anything surrounding those dates where the Treasury might in fact run out of money. And even though we think it's a low probability, they shun those, and it's really because they can't. They simply have to have that money, and they can't get it 3 days later. So, I think it's disruptive, but our base case is that it does resolve itself, because we've been through this before, and the last time they let it go, it didn't work out good for either of them. Brian?
Yeah, we would echo those same comments, and it was quite a timely question, Dave, because Chairman Powell and Secretary Yellen are actually talking right now to Congress and really trying to push them to get this deal done. And per our comments earlier, and it echoes what Margaret says, they'll get the deal done. And this is in 2011, when you had a much more contentious situation, the debt downgrade in the United States. So let's not go back to the myths and untruths of every time this happens, the market goes down. In fact, I think markets will probably rally when they start to feel better about this. Plus, remember too, the end of this week is the end of the calendar quarter too. So you're probably going to see some activity because of that.
Can't wait. I do feel we've been there a few times before. So Angelique, Brian, Margaret, Paul, really appreciate your time. I know our clients do, and I appreciate your honest, robust, and candid answers. To our clients on the call, thanks again for joining us. Thanks for being clients, and thanks for being prospective clients, because you're not all clients yet. It is a tough time. It's challenging for all of us as business leaders, and I want you to know that all of your BMO reps are with you and are available any way we can be to help in many ways. If it's keeping the lights on in your operations, we can do that as well. But in all the cases, we just want you to know we're here and we want to help, and we want to get this economy continuing to move in the right direction. So thanks to everyone. There will be a recording of this call on our website for those that couldn't make it now. And thank you again. Thanks to all of our guests and to all of our listeners.